and that's their kind of bear thesis for yields going up, prices going down, where I think you would be in kind of my camp, where it's like, nah, I don't see any evidence that supply really drives yields. I think it's more about inflation and growth. And when I look into the macroeconomic outlook for the United States, I don't see this reacceleration like we had in 2021, 2022, where we go, although we have gone from 2.4 to 3, it's unlikely that we go from 5 to 9 to 12, like something like the 1970s. And therefore, the yields may be ahead of themselves. So we could see a decline back down sub 4, which would be more in line with what you think growth and inflation expectations will be over the next 6 months. I don't want to put words in your mouth. But.
No. Listen, you could you construct a macro case that is framed that way. So, but let's talk technicals. To complement that, right? And so here I put the TLT and I put it on a little bit longer term, so you can see some of the lower years. But the way that I would translate it is that there's a very good chance that this will be the bottom.
I can't see how
this is 2024. So by the way, here, this is the huge bond bear market that happened from 2020, where we basically saw almost like a 40-50% wipeout in treasury bonds on the long bond and that vicious decline. But you can see that it's starting to look like a bottoming formation that we've now created the lower boundary of this. And I think this is the way to approach this thesis, which is I don't want to fall into the trap of trying to make too big of a macro call, like we're going back like last decade to 0% interest rates. There are people that want to make those calls. Let them make it. I want to look at it as a trader. As a trader, to me, I don't see any reason why we can't go to the same levels of bonds and interest rates that we were at last year.
Yeah, and so last year, 3.8, right?
Right. And so, or even the one in 2023, whether you're looking at TLT going back to 100 or TLT returning back to 110, I don't see any reason why we can't see those levels this year. And
that's good, because I've got calls at 110. I think
right, exactly.
They're about a year out,
and so we have a scenario where I think that these things can move. But the bigger question is, let's talk about which are the two ways to express our views on interest rates and bonds. One is playing the long bonds, which is the TLT, and it's a play that generally disinflationary pressures start to emerge, economic contraction starts to emerge, and generally the level of interest rates and inflation expectations on long duration inflation expectations start to come down, allowing bonds to have this big rip on the upside.
Yep.
And so that is a macro call on the economic circumstances. But at the same time, this is not necessarily the best way to play what you believe the Fed is going to do. The Fed is all about shorter term interest rates. And this is where we can talk about SOFR futures and 2-year yields and other types of shorter dated ways to play this. Now, obviously, SOFR futures have replaced euro dollars. I'm sure many of your listeners have heard Eurodollar University, Jeff Snyder, talking about this. So SOFR futures are his universe. Like, this is where interest rates and all function on that short term. So some really interesting observations I want to make about what future interest rate expectations are being currently baked into the market.
Yeah, and so, Patrick, before you go on, I just want to explain a couple things you said there, just for people who might have missed it. You're talking about that, you can't really look at the front end of the curve there. And a great example is the Fed has dropped rates by 100 basis points since September 18, 2024. And during that time, we saw the 10-year Treasury yield go up by 100 basis points.
Right.
So you can't just sit there and say, well, the Fed's going to do X and therefore the long end of the curve is going to do Y.
Yeah. So, and to speak to this point is that you could look at the yield curve, right? Which is, here's your 2s, 10s, right? And we obviously spent almost a couple years trading at inversion, where we were below 0% on the 2s10s curve, and we've now steepened, which is often actually a sign that typically is interpreted bearishly, as bull steepeners tend to.
Yeah, that's usually when you get the
recession and the Fed cutting, because most recessions happen during Fed cut cycles, because the Fed realizes the R-star is much lower, that they've slowed the economy too much, and they need to start easing aggressively, causing short-dated interest rates to collapse, short-dated bonds to rally, and allowing this 2s10s to steepen in a big way. And that is the play on that. So let's talk briefly about what markets are currently pricing in. And so the first thing I want to start with is looking at March SOFR futures. And so now the way, George, that your listeners can think about how to interpret the price level is take whatever price level this is trading at minus it from 100. So to get the interest rate. And so with this trading at 59.70, sorry, 90. So I'm being dyslexic here. 95.70. If it's a 95.70, but the difference between 100 and 95.70 is like 430. So the current interest rate is 430 basis points that's being priced until March.
The current projection, right? And just to be real clear, guys, the SOFR rate pretty much replaced LIBOR. So it's basically the SOFR is telling you what the market thinks the Fed funds rate will be in 3 months, 6 months, a year, etc.
Exactly. They're basically pricing in future interest rates all the way out, and these are short-term interest rates.
Fed
so this
funds.
is Fed, well, 3 month. This is particularly 3 month rates, not Fed funds, but it's still going to be influenced by Fed funds, right? 3 month rates is very, very short term money.
Okay.
And so the point here is that they're pricing that in. So now let's go to the end of the year. So let's go to December of this year, and we are trading here literally at 96, which is 100 minus 96 means that's a 4% interest rate.
And you said this is projecting out a year.
Yeah, to December, to the remainder of the year.
Okay, the remainder of the year. So December, the market is saying they think the 3 month T-bill will be right around 4%.
Yeah, which basically means that they're looking for one rate cut. Right now, currently, the anticipation is at some point there's going to be one more 25 basis point rate cut coming in this year. Now, go out even 1 year further, and you have December of 2026. Now, 2 years forward.
Yep.
And it's still at 4%.
Wow.
So what we now have is a SOFR futures market that is currently so uncertain about the interest rate path
that's frozen,
that they're frozen into saying that we right now they're pricing in a Fed that does not act for the next 2 years.
And the probability of that is almost zero. And not saying that they'll go down. I mean, I think they'll go down, but maybe you want to argue that it's going to go up. But I can almost assure you in 2 years, it's not going to be the exact same.
Right. And this is where I think there is an amazing trade, because whether you go 1 year out or 2 years out, there was two events that happened in the last year. Let's call it the last 15 months. That where when the Fed was initially indicating pivoting back, that started that huge October market rally back in 2023, we had the market go from pricing in 0 cuts to pricing in 7 to 8 rate cuts in literally just a few months. It was one of the most extraordinary rallies that we had in SOFR futures, as they basically went and started to price in a super dovish Fed.
Right.
Then, when everyone realized that the Fed is not going to be remotely as dovish, they literally pulled all of the interest rate cuts back out of the market by May. So by the middle of second quarter, they basically went and pulled all 7-8 rate cuts out. Then comes the summer, and we have the Japanese yen crisis there that happened with the where we basically had the carry trade blow up.
Yeah.
And suddenly the market went in and priced in another 8 rate cuts almost immediately, like the world is ending.
It's totally bipolar.
Yeah. And then
they're pausing, they're cutting, they're pausing.
Yeah. And then now they pulled it all back out.
Yeah. Yeah. Now we're back to pause mode.
And so in my mind, I'm like, okay, we got Trump hammering tariffs, huge uncertainty about things, the whole world going through all of this kind of uncertainty about how things are going. There is so much room for there to be economic contractions. Now, let's not call it a 2008 financial crisis. Let's not call it some doomsday scenario, but the chances that all of this trade war stuff actually slows the economy can happen.
If at any, have to point out too, Patrick, that the United States right now is the outlier by far, and most Americans don't realize this. But when you look at Canada, China, Germany, Eurozone, UK, I mean, these economies are very, very close to not, if not in recession right now. I mean, China's going through basically a GFC.
Yeah.
So you got to remember, Americans, that the United States, they are, again, they're the outlier. So, you know, is it outlandish to say that the United States, there might be a slight probability that the United States will join the rest of the global economy that, as we know, is very interconnected. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.